Well, as you mentioned in your intro, global markets at the moment are in risk-off territory, with investors obviously fearing the heightened inflation coming out of the US and getting that CPI print for April tomorrow, with consensus at around 3.6%, which year on year, which is significantly above the 2% threshold. And obviously, the concern is whether or not this will be transitory or if it is a step up in inflation for the foreseeable future.
So some of the reasons to explain the tech sell-off what we saw yesterday, is it because of these inflation fears?
Well, we've been in a Zurich environment for over a decade, where the Fed and ECB, as well as Bank of England and the Central Bank of Japan, have had significantly low interest rates, and obviously this is a boost to asset prices globally. But since last year, the Fed expanded this by increasing its QE, or government bond purchase program, to about $120 billion per month, and they continued this up until now. And so obviously the concern is with rising inflation, and if this continues longer than what the Fed has outlined, will they cause another taper tantrum, which we saw in around 2013 with the ECB signaling that they would start to raise rates because of global macro recovery. So this time is obviously inflation-led, and that's negative for asset prices, especially equities, which are at historically high valuations based on various metrics such as CAPE ratios and relative PE ratios. And obviously this impacts the tech sector the most, whereas other sectors that have historically high dividend yields or able to pay out dividends and are trading at lower valuations will be slightly less affected. But we do know that there are some concerns around valuations, especially in sectors like tech, which have done well over the past year. So in some cases, it's sector rotation into areas like commodities, which obviously are doing very well because of global cost push inflation, as well as traditional value sectors, which are starting to perform better as economies open up and bricks and mortar retail starts to recover.
So, I mean, you were talking about those commodity prices, and which is a nice segue into my next question, because yesterday we saw copper and iron ore surge as well. Is this an indication of some kind of global recovery that the market is expecting?
Well, iron ore prices above $200 per ton, just over a year ago, under $100 per ton, mostly led by China. More than half of global iron ore demand comes from China. And for various factors such as the trade dispute between China and Australia was a large supplier of higher grade iron ore into China. So now China obviously looking for other markets, and those markets are not readily available in the short term. Of course, there are companies which are looking to expand iron ore output, but those new volumes will only come online in the next few years. And so you've had a lot of cost push with Chinese demand from iron ore, mostly due to domestic steel prices increasing, and those a function of infrastructure spend, which was a form of stimulus that the Chinese used last year. And if we look at Chinese GDP growth over the past few quarters, it has been reliant on investment, with consumption demand and retail sales starting to recover. But for China's overall GDP growth targets for the next year, they still are reliant on investment-led growth, and so that means further infrastructure spend, and iron ore and copper, the major base metals that go into construction, appliances, and various other demands. And also you can add on to that increase in US demand. US imports from China have been increasing significantly this year, especially since the stimulus checks have arrived, which have boosted consumption demand. And so there are many factors that have led to this cost push inflation. And at the moment, there is a bit of a supply pitch, and so prices will continue to rise for the foreseeable future.
While we're on the topic of factors, I mean, yesterday the Rand made headlines. Do you think that there are enough factors out there to support this narrative of of more gains going forward?
Well, it's always very difficult to predict the Rand, and anybody who tries to predict and short term is 99% likely to be wrong. What we can say is that looking at global fund flows, and obviously risk sentiment is a big part of that, relative real yield is also another part of that. We know that 10-year bonds in South Africa are at somewhere around 9.7% nominal. You compare that to 0% in Europe and 1.6% in the US. It obviously spurs on the carry trade despite risks of default in the longer term in SA. Similarly, South African equities have been relatively undervalued relative to global equities. So those who have a slightly higher risk slightly higher risk budget may also allocate to local equities on views of a local demand recovery. And so those capital inflows, and just over the past week, I think of 5 billion rand net inflows into local bonds, do speak to a strengthening rand. We're at around 14 rands per dollar. If you look longer term at purchasing power parity, it's a good signal that we're fairly, if not slightly overvalued in a sense. So longer term, you may see some easing closer to around the 15 level, but in the short term, it's very difficult to say what will happen.
All right, on that note, thank you so much for your time. That is Thato Mashigo, who is a portfolio manager at Sanlam Private Wealth. That's it from me. We're going to